Hello and welcome to Pro Trader Strategies Market Commentary for Wednesday, August the 30th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. And please remember the past performance of any trading system or methodology is not necessarily indicative of future results. All right, having that out of the way, let's get it on. We actually have quite a bit of economic data today. I didn't think we really had anything until Friday, but then started looking at today's numbers, and we do have quite a bit in a sense in store for us. So let's start out with across the pond. We had over in Germany, we had the CPI, Consumer Price Index, came in at 0.1%, right in line with expectations. And then in Spain, we got the flash CPI, which is the Consumer Price Index. Now their flash CPI is more widely looked at than our flash economic data points, so keep that in mind. But the Spanish CPI came in year over year at 1.6%, was expected to be 1.7%. And then here in the United States, we got ADP non-farm payroll, which came in at 237,000 hires, was expected to be only 185,000 hires, so quite a bit higher than expected there. And then they also revised last month's number up from 178,000 to 201,000. So really good economic data points out of ADP. Now keep in mind Friday's non-farm payroll is more widely looked at. Usually ADP kind of gets shoved off because it comes out just ahead of the non-farm payrolls, and it has a tendency to be a little bit more inconsistent, to say the least. All right, so then here in the United States, we've got our preliminary GDP numbers. Quarter over quarter came in at 3%, which is quite nice, much better than what was expected, 2.7%, and just a really nice rounded off number. Most of that GDP was actually from cell phone sales, believe it or not, and some energy like natural gas and things of that nature. But the cell phones was a real big driver of that. So it seems like people are not afraid to spend $1,000 on a cell phone, which is good for the cell phone carriers, despite the fact that we're seeing a little bit of weakness in Apple today. And then here we have preliminary GDP price index came in at 1.0%, right in line with expectations. We also have Fed Governor Powell speaking, and here in the United States, we got crude oil inventories. The EIA crude oil inventories was a drawdown of 5.4 million barrels, was expected to be a drawdown of 1.8 million barrels. So a big drawdown earlier on today. It was surprising. Even after that economic data point, we were seeing crude oil futures in negative territory, which was really bizarre. We did settle back above this trend line that I've been talking about yesterday, moved back above that, settled above there, so that was a win for the bulls in a sense that you get stuck in that trend and it's going to be really looking pretty bearish. But after that EIA number, I jumped in and sold some USO that I'll talk about here in a minute. Basically, also this evening we have Chinese PMI manufacturing numbers, and then out of Japan industrial production, and word on the street is those industrial production numbers are looking pretty robust. So they've been doing pretty well over there. So I think that all has to do with the economies of scale globally starting to look a little bit better. So we could easily see those numbers come in better than expected, at least I believe. All right, on to the overall markets. We talked about crude oil here, up 20 cents, moving higher. With that said, we can move on to gold futures. Gold just really looks pretty toppy to me. It blasted out. Remember I talked about it getting the shorts that were probably trying to sell this level and flushing them out. I think that that's kind of blasted off to the upside. And Doug trying to distract me as they know how to open up doors. And then on to the bonds. We're talking about this. Bonds really can't go anywhere. They tested this value area high, settled back below that. I think it's going to start to look to roll over here, especially with the equities probably going to test all-time highs here pretty soon in the very near futures, or very near future, I should say. Dow Jones in negative territory. I think more people are trying to rush the technology for the most part, but we have Dow Jones slightly in negative territory despite the fact that we're seeing pretty good economic data points. Here's the NASDAQ up 34 points. One of the things that's really holding the NASDAQ down right now is Apple, and it being a big weight in the NASDAQ. That's probably holding that back from looking a lot better. Then we have the E-mini S&Ps up 4.5 points on the day. If we look at the daily chart of the E-mini S&Ps, yesterday was just a crazy day with the amount of euphoria around the markets, despite the fact that we were seeing what North Korea was doing and things of that nature. Kim Jong-un probably has lost his mind. It seems like just about every country is really against him right now, and with them adding more sanctions to North Korea, they could really be struggling in the near future. But we have the equities up. I thought that we'd see them up a lot more than what we are, but they are still in positive territory, at least other than the Dow. Gold futures, I talked about this yesterday. I was looking to add some short deltas with gold. It's up. GLD, which is the ETF for gold, it's up 1 penny right now. But at the end of the day, I decided yesterday, late in the day, to go ahead and add some shorts with GLD in my margin account and in my IRA. So in my, let's talk about the IRA first. I have I put on the September, sold the 125.5 calls, and then bought the 126.5 calls. And I ended up paying 30 cents for those GLD call spreads. And then in my margin account, I went in there and sold the SEP 128 calls, and I was able to sell those for, I'm going to have to check that. I sold those for 31 cents. So basically, I did the call spread and the outright calls for about the same price. A lot more risk in my eyes in the IRA because I am closer to the market. Remember, I sold the 125.5 calls, and in my margin account, I was able to move it out $2.50 to the 128 calls. So a lot more room for error on the upside in my margin account, which is one of those things with your IRA that you have to deal with. And I'm actually going to be talking about this in Festival of Traders, so you can check that out at Pro Trader Strategies. Also, I'm going to talk about how those different risks are associated, and it seems though that you're having a limited risk with the spread, but at the end of the day, your probabilities of being tested and having that trade go against you are much higher than if you were to be able to just sell it out naked. So we'll be talking about that next Tuesday on the 5th. All right. On to, excuse me, XLK. XLK is a trade I took off in my margin account. I'm haven't done anything with XLK in my IRA, but in my margin account, I went in there and sold out the September 56 puts. Originally sold those for 29 cents, bought them back for 15 cents this morning. So real close to 50% of my max profit on that one. So out of XLK, nice move yesterday, and continuation of that today. A little bit of value, or a little bit of implied volatility coming out of that trade also helps. So directionality, volatility coming out both of those things allowed me to get out of that trade rather quickly, and I didn't have that trade on for very long at all, so that was quite nice to get out of that rather quickly with the directional move that we got there. Then on to PayPal. Now PayPal, again, trying to get out of this in my IRA, but in my margin account, I was able to get out of this rather easily. So in PayPal, I sold the September 58 puts and originally sold those for 60 cents, bought them back for 23 cents this morning. So was able to get out of those easily. Sold those for originally 65 cents, bought them back for 23 cents. That move happening yesterday and today, the continuation volatility coming out, was able to get out for better than 50% of my max profit. Whereas yesterday, wasn't able really to get out of that for, it was really close to 50% of my max profit, but I just waited on a day after yesterday's big move. I was kind of wanting the penny rather than the trade. So was able to cover that this morning. But again, in my IRA, I'm trying to get out of that trade right now, and I have on the September, and I'm short the 59 puts and then long the 58 puts as that spread. So originally sold that for around 30 cents, trying to get out for a little bit better than 50% of my max profit. Hasn't happened yet. So on to USO. This is a trade that I added today. The USO chart looks a lot better than the crude oil chart on with this doji here. It doesn't really show up as much in crude oil because it trades overnight and things of that nature, whereas USO, being the ETF, only trades during the day session. And so I added a couple of trades in USO to my margin account and in my IRA. And in my IRA, I went in there and sold I bought this spread because we have super low implied volatility, and went in there and bought the October 8.5 calls and then sold the 10.5 calls for, paid 95 cents for that. And then in my margin account, same thing, bought the 8.5 calls, sold the 10.5 calls in October, paid 95 cents for that. So looking forward to trade up there back into the value area, which would be kind of right in here. If it goes back up here to this high volume node, that would be great. Have that on in October, so that gives me about a month and a half to be right. Hopefully we'll start seeing some of this. There's a lot of things going on with crude oil that is bullish. For one, we're seeing consistent drawdowns more than expected. We're also seeing, unfortunately, the hurricane in Texas, which is affecting oil in Houston. No telling how long those refineries and things of that nature are going to be able to get up. I mean, they've gotten like 14 trillion gallons of water dumped on them. That is going to take them offline for quite some time. Also, as that storm moves up and through the Midwest, we're going to see those waters start to flood into the Mississippi. And as the Mississippi floods out, in a sense, when that water hits down near New Orleans, that is going to affect their distribution and things of that nature, because they send oil up the Mississippi. That's going to take that offline a little bit. So I'm kind of getting really bullish on crude oil, just for all of these economics that are going around, in and around that, and the logistics of trying to get that oil out of these major ports. All right. So that's about all, other than I was going to show one chart of Apple real quick, just to kind of give you an idea how it was looking a little bit toppy in a sense, at least earlier today. I don't know if it's still going to do that, and probably take quite a while for my thing to load up here. It doesn't look like it's going to do it. I got too many things running on in the background. So anyway, Apple could be looking a little bit toppy, and that's what I was talking about with it holding down the broader markets on the NASDAQ. All right, that's about all I got for you guys today. Check out the Friday webinar. It is going to be a good one. It's going to be on the long straddle. Now, that's one of the strategies that anybody can set up. It's easy to figure it out. Basically, you're selling the at-the-money, buying the at-the-money call and the at-the-money put, same strikes, pretty easy, right? At the end of the day, there's a certain type of environment you want to be implementing that strategy in, and there's a lot of environments where you don't want to be implementing that strategy, because this could become very painful if you did it in the wrong type of environment, right? So if you can't take that, take it easy.